People are looking into next year, trying to figure out exactly where stocks are going to go. You guys are at 5,100 for the S&P. What gets us to 5,100 by year-end 22?
Well, I think there are a couple of things that really supporting a still positive view on equities. One of them is that the economic cycle is still intact. It's slowing from the pace this year. Globally, GDP growth this year was around 6%. We're expecting 4.5% in 2022, so still above the long-term trend growth rate, and even at around 3.5% into 2023. So as long as the economic cycle continues to expand, we would expect profits to be growing, and that's the principal driver of returns in equities. But the other important point, of course, is that as you have been discussing, inflation is picking up, policy rates remain at all-time record lows, real interest rates are negative, and that's pushing investors understandably into real assets. Bear in mind that the dividend yield on equities is still pretty positive, and the corporate sector is very cash generative. So this is really a real yield, and I think that's what's really driving the continued push higher in equity prices, albeit at a slower pace.
So, Peter, if that's the case, is it still going to be U.S. equities, emerging markets, or is it going to be time for other areas? And in that, are bonds a hedge anymore for these rising equity prices?
Well, two really good questions. I think the first thing is context. The last cycle after the financial crisis was so dominated by the US equity market outperforming, and that really reflected two things. Firstly, greater success in the US economy than elsewhere, and secondly, the great success of the growth factor and in technology companies in particular, which were very heavily represented in that index. Other indices, particularly those in Europe, were much more heavily exposed towards troubled value sectors, banks, energy, and so on. As we move forwards, we find that the profit growth differences between the US and other markets are likely to be narrowing. Technology is still doing well. It's becoming a bigger component of other markets like Asia and Europe, but also the very troubled areas are no longer facing the same kinds of headwinds. And actually, they've been the areas where you've seen the biggest profit recovery this year. So overall, we would be arguing for much more diversified geographical exposure. We don't think the US is going to do poorly, but we think that there are good reasons to be less geographically specific and more diversified as we move forwards in time.
So Peter, to that point, we're going to get to Europe more specifically in just a second. But in terms of then hedging it, is it going to be bonds? Is it gold? Is it Bitcoin? What is it?
Yeah, well, bonds are not a particularly good hedge, I think, now. Again, if we look back at the last cycle and even over the last 20 years, you've seen an exceptional period of returns in the sort of 60-40 equity bond balanced portfolio. And that's because both major financial asset classes have done extraordinarily well as interest rates have moved towards zero. But also in the periods of time when equities were facing stress because of recession or fears of deflation, bonds were a great hedge. I think as we move forwards, given we're at record low historic bond yields, it's difficult to see the same kind of returns. In fact, we'd be expecting negative returns in bonds as we move forwards in time. So it's not a great hedge for a higher equity weighting. And so cash probably represents a much better way of hedging against an increased exposure to risk assets like equities and other risk assets and real assets as well, like commodities, where we've been structurally positive.
Peter, let me make the pivot to Europe. Alex brought it up. You've been talking about it. I've got a chart here. It's the stock 600. We got through 490 a little bit earlier on. We've retreated a little bit, 489. But this is a long-term chart, and you can see that European equities have been moving up. They've underperformed broadly what we've seen in the United States. We're only really starting to play catch-up. So that's the kind of context. 489. I think you are kind of you're expecting further gains next year as well. But the key question, I think, is this one here, which is a fantastic chart at the moment. The European discount to US stocks is at a record. We're at a 30% discount, Peter, on a forward PE basis. We've been traditionally kind of 20, 25. Throughout my entire career, I think we've been in a situation where that discount has existed. But we're now at 30%. What does that tell you about the story for next year? Do I want to make that pivot to Europe? Is that discount going to continue to widen? What do you expect?
We expect the discount to start narrowing. We have to be careful with valuation because there's been a big valuation discount in Europe relative to the US for a long time. And one could have made the story that would have created an opportunity for European outperformance. It didn't happen, but that's mainly because the fundamentals didn't support it. The last cycle was so dominated by growth outperforming value that the markets that were heavily weighted in the growth factor, the US in particular, with its especially high weighting in technology, was outperforming, and the falls in interest rates were supporting longer duration assets. But I think as we move forwards, this record discount does make a difference because the fundamentals are shifting a bit. The value areas of the market are likely to benefit more if we do get higher inflation or bond yields. Steeper yield curves help, for example, banks. Higher commodity prices help energy, resources, and so on. And also, we're not seeing the same negative drag on European economic growth moving forwards. In fact, we're looking at well above trend growth in the European economies next year, pretty similar to the US. So I think that discount is probably too big. It's also worth mentioning that even if we adjust the two markets, the US and Europe, so that they have the same sector exposures, Europe still trades at a record discount. So I think that for people who are looking at value, are looking at some diversification, Europe is a good place to be. And actually this year, for the first time for well over a decade, it's roughly held up with the US, achieving mid 20% return so far. That's pretty decent, particularly when it's still got quite a low weighting in technology.